Hey, everybody, welcome to the 65th week of doing this. And as you guys are jumping on here, I'm going to be looking for Harvey, who gets the early bird gets the worm award, because he sent us questions already from Hawaii, said he's going to get up at 4:30 a.m. Hawaii time so that he could be on this thing. So if that is the case, Harvey, I'm looking for you. There might just be something coming your way. We're gonna have to get your contact information, but I don't see him on here yet. So maybe he hit the snooze alarm, but we do have questions that he asked. So anyway, so we've got all kinds of fun and frivolity. We also actually have a guest host on here, co-host. It says that it's Adam Boatsman, but it's actually Matt Andersen. So we're happy to have him on here because Adam is going to be away for a couple days while we're doing this in the next couple weeks. So we need a stunt double. So we enlisted Matt. So Jack, it's good to have you back on here too. Adam, I think you had some rants that you wanted to go on to, possibly with the fact that the Republicans and the Democrats still seem to not be getting along on this infrastructure plan. So you have any thoughts that you want to hit on that?
Yeah. So, I think, generally speaking, if you just look at, well, why has the conversation broken down? Again, I'm not trying to be a political pundit. I'm just trying to be an honest broker of information for the limited viewing audience that we have here as it relates to taxes, because somebody's going to say, oh my God, it broke down. Now my taxes are going up. All right. So, basically the Republicans on the infrastructure plan, when you hear to face value, Biden wanted $1 trillion. The Republicans wanted $1 trillion. We should be able to agree instead of going like this and barking at each other. So, I think the primary difference was that the Republican proposal had just a repurpose of some funds that already are that haven't been used from existing stimulus. So, for example, unutilized PPP funds would be an example of, hey, let's just repurpose those funds. I don't know if that's the right thing to do, wrong thing to do. That sounds, you could probably make a case for, a case against that. But I think the one thing that I did want to hit on in terms of what you are hearing a lot about is that Republicans are drawing a line. And so the talks are broken down, but there's still a bipartisan group that's trying to get something negotiated. If the bipartisan group doesn't get something negotiated, then if they really want to pass something, then they'll do it through the reconciliation process, which is the same way they did this last round of stimulus, which means only requires 50 votes. Presumably all the Democrats will go for it, and it'll just get reconciled between the House and the Senate. No filibuster can happen in that case. So you hear a lot of talk about, oh my God, Biden's going to raise corporate taxes and it's going to make the U.S. non-competitive and, all that value. So what's getting lost in all the noise is that when they're talking about Biden raising the corporate tax rate, what he has proposed is to raise the rate itself from the existing 21% that it is today to 28%. This would be for C corporations, which not many of our clients are C corporations, but this would affect C corporations primarily. So 21% to 28%. However, the average rate actually paid by Fortune 500 companies is somewhere in the order of about 13%. So even though we have a 21% rate, the rate that Fortune 500 companies are actually paying is about 13%, because they make use of foreign jurisdictions and other tax planning strategies that if you want to log into, shoot Gary a text, and we've started to develop some content around, how big companies don't pay taxes and how you can not pay taxes too, and all sorts of other good stuff. But, remember that we're talking about raising a rate that really hasn't changed a whole lot in several years. So, basically it doesn't matter what the hell they do to the rate. Companies are still going to pay that 13%, whether it's 21% or 28%. It's not going to affect big companies. So what Biden has proposed is to raise the rate, but at the same time, he said, you know what, I'll take that rate totally off the table. I will take the rate increase totally off the table, but I want to implement a corporate minimum income tax rate of 15%. And I didn't get a whole lot of, I didn't see a whole lot of traffic back and forth on whether the Republicans viewed that as a rate increase or not. It's just proposing a different way to calculate your tax liability. Well, what happened in parallel is that at the G7, kind of the pre-G7 meeting, with all the finance ministers of all the different countries, the G7 agreed to a 15% minimum tax rate because everybody's kind of fed up with, hey man, I don't like my tax rate here, so let me incorporate in Ireland. Well, I don't like it there, let me incorporate there. Well, I don't like it there, let me incorporate there. So they proposed a global tax system amongst industrialized companies at a 15% rate based on your global income that will be allocated to each jurisdiction based on how many sales that you had there. So you had companies like Facebook that came out and said, we totally get it. We're going to need to start paying taxes, and it's going to be based on sales within a different country. So you're starting to see some acceptance of major corporations that we probably need to go from a territorial system, which is what we have today, to a global system, which, the other finance ministers have already agreed to. So I feel like there's a lot of momentum behind, this being a potential fix to big companies not paying their fair share. And just, if you haven't been on the call for a while, or if you have been on the call, I'm going to rant against it again. Duke Energy, right in our backyard, love Duke Energy, employs a lot of people. Duke Energy will ultimately pay its fair share of taxes. It's used perfectly acceptable legal means of deferring taxes up to this day that a lot of our clients take advantage of. But that built up liability that Duke Energy owes the US government right now is $9 billion. So last year, Duke Energy only made $1 billion. So it's got 10 years worth of earnings stored up in future tax payments it needs to make. At the existing tax rate, it'd take them over 50 years to pay off that liability, in addition to whatever they have to pay going forward. So it makes sense that they need to fix something. So it's a long way of saying, when you hear about, oh my gosh, tax rates are going to go up, not in the last go back and forth that went around. And I think if there's a bipartisan compromise to get, or even if it goes through reconciliation process, I don't see Joe Manchin and Kristen Sinema voting for a rate increase unless it's this kind of rate increase. The other thing that I could see happening on the pass-through side, which would be S corporations and partnerships, I could see them also making S corporations subject to self-employment tax, because they've talked about doing that for years and just never done anything with it. And that would make it at an equivalent level to partnerships. And I could also see them putting in place, paying Social Security taxes again after the $400,000. So that's just my guess at where things might go, in addition to the step up in basis when you die, and make it like eliminating that to where if you die, at some point, the person that inherited your stuff is going to have to pay capital gains tax, because the way that it works now is that, if I die with the stock that I bought for $1, but now it's worth $500 and I leave it to Jack, Jack's new basis is $500. If he sells it tomorrow, no tax paid, and he paid no estate tax. So again, most people get more conservative when they get older. I seem to be getting more liberal, but I don't know how that happened. But to me, that just sort of logically makes sense, that no estate tax and no capital gains tax ever. Like the argument around, I don't want to have to pay tax twice. I got it. I'm all for elimination of the estate tax. That's dumb. But to never have to pay capital gains tax, it's a great tax planning strategy, but it doesn't make any sense. We're going to pursue it till the gates of hell and back. It doesn't mean that it makes sense. So I could see him making a change on that front too, since dead people can't vote, and you're really targeting getting dead people to pay taxes. I think the last thing that I'll hit on, and I'll stop my rant after that, is that another thing that it's possible they get rid of is the 1031 exchange on real property. They already got rid of it on tangible property. So, planes, all that kind of stuff that you used to be able to, buy, then trade up, but not have to pay the taxes on the massive depreciation bill that you took, would go away. Presumably, same thing would happen with 1031 exchanges. Gary shot me out an article saying, predicted job loss if that happens. I don't know if that's true or not. I mean, for sure, what it would eliminate would be the need to ever have a qualified intermediary again to hold your money on a 1031. So, that would be the equivalent of like the barbecue whip manufacturer going out of business when we got the car. Like 1031 intermediaries would not need to exist anymore if they eliminated the 1031 exchange. At the same time, I think in the conversations that we have with clients, we always tell people, look, ultimately, it's a kick the can move. You're eventually going to have to square up with the government. You're just debating when. So, really, it's a timing. It's one of the ultimate timing differences that exists within the tax code. So, I think that what we'd end up seeing happen is that, you'd have to pay some taxes as you go on real property, but it behaved very similarly to the plane analogy where, I sell something, recapture some depreciation, but I buy something new, I get to redepreciate it, all that, those things wash out. And I'm really kind of just stuck with the capital gains tax difference. So that would be one that would have an impact on our clients, not in terms of a rate increase. It would be more not having the ability to defer a tax liability, whereas I used to be able to defer in the past. So, rant done, drop the mic.
Well, since I'm the oldest one on this call, I'm definitely getting more conservative. So we're counterbalancing each other.
Yeah, I gotta keep up to offset you, Gary.
So, Jack, first of all, let me just say this. Harvey in Hawaii, I see you in our participant log. So some stuff is coming your way. Send me an email. You've got my email address with your mailing address as well. And a small little gift package for, waking up at dark 30 to be on this is really amazing. So before we get to Harvey's question, because he did get his questions in first, Jack, do you have something? You're sitting there like you do.
Well, I'm just wondering why Adam didn't go further into the whole 1031 exchange thing. And that article that he referenced was, so obviously, if you read the whole thing, it's very biased in one direction. But the quote is, the effort would generate, so dealing with or removing the benefit of the 1031 exchange would generate $19.5 billion in tax revenue over 10 years and help pay for part of the $1.8 trillion proposal to help American families attain a middle-class lifestyle. And so, what they're saying is that, well, hey, this is going to generate a lot of tax revenue, but then according to their numbers, there's already a lot of tax revenue that's already generated, even in 1031 exchanges or outside of that. So very interesting. As far as the infrastructure talks ending, so what's kind of funny is that in this, I don't make political statements. I just tell it how it is. And it's kind of funny that the White House basically was negotiating with a group of Republicans, and in this article it says 6 Republicans, and then they got to an impasse, and I'm like, all right, we're not going to deal with you guys anymore. We're going to go over here and deal with this other group that's been kind of meeting together, and that group consists of, it's called the Problem Solvers Caucus. It's a group of 29 House Democrats and 29 House Republicans, and have been getting together. So they're looking to them to say that, well, let's see if we can figure it. Maybe this group can kind of figure it out better. And what's interesting is this article says, in order to get it passed in the Senate, Democrats would need the support of at least 10 of the people that they just basically jilted in the other group and others, right? And so a lot of just political back and forth and just trying to get things done, but they'll probably end up going through the reconciliation process as they've done before, and as Adam mentioned. Good news on the Restaurant Revitalization Fund, and this came out yesterday. So Congress is introducing a $60 billion replenishment of the RRF, which essentially more than doubles. You remember the original amount was like 30, is like 28.6, 28.8 or something like that. So they're going to introduce it, and obviously it has to go through the full process of being authorized. So that's in process because the money ran out pretty quickly. I think they were not expecting as much of a draw on that. A couple other things. I read this and I cut and pasted it. The NC Senate passed a tax cut bill to eliminate the corporate levy, and I think Adam was kind of talking about that a little bit, but specifically with the Senate, and this is just, they're saying they're going to cut taxes by more than $2 billion over the next 2 years and reduce some other stuff, but that has to go to the House. So we'll see where that stuff goes. But unfortunately, none of us will be amending any of our tax returns for the issue we've been talking about previously, about the penalty with, giving one hand and take it away from the other. And then in totally just random news for those of you that are PSL owners and we're worried about just not getting any money or being worthless, apparently Mr. Tepper said he's not going to build a new stadium anytime soon. So your PSLs have a little bit of value, but not much. So there you go.
Woohoo. I like the fact that Tepper said if he's going to do it, he's going to put in a third of the money. The PSL people put in a third of the money, and the city will put in a third of the money. And if people don't want it, he's not forcing it down their throats. That's actually a really good move. So, Matt, I'm not trying to avoid you, but Harvey got up at 4:30 his time. And I want to deal with his question because it's kind of a story problem. So take some notes here. All right, Harvey, we're getting to it right now. Aloha, guys. Hope all is well in North Carolina. Things are picking up here in Hawaii. Tourism is back. Although we miss the Japanese tourists, they spend way more than those mainland guys. So if you are an American and you're traveling to Hawaii, come on, man. The reputation is there. We've got to step it up. All right. Was wondering if you guys had any additional thoughts on what qualifies for supplier costs. We're a printing company whose main costs are wages and COGS, paper, inks, consumables, different substrates. I'm assuming that our COGS for the paper, inks, consumables, etc., don't qualify as supplier costs, but I want to double check with you guys. We pay lots of rent, but it's to a related company, so it's limited to the interest on that related company's mortgage, which isn't much. Trying hard to find some other costs that could go into the non-wage bucket as nowhere near the 40%. Trying to save as much wages as we can for ERC. Any thoughts or suggestions on what might be qualifying as covered supplier costs for a business like ours? And he does have a follow-on, but let's address that first.
What was the follow-on? To see if it was related.
Say that again.
Well, what was the follow-on, if you don't mind skipping that too?
Okay. Other category I'm looking at is covered operation expenditures. Covered operation expenditures or payments for any software or cloud computing service that facilitates business operations, product or service delivery, the processing, payment, or tracking of payroll expenses, human resources, sales and billing functions, counting or tracking of supplies, inventory, records and expenses. That's probably from the legislation. It says we have a lot of operational software costs for various software used to run our business, and typically have license renewals that when paid go to prepaid expenses, then amortized over the license term, sometimes more than a year. This operational expenditures, in quotes, category seems pretty expansive. So I'd love to hear from you guys on what you think of these software license costs that I mentioned above.
Yeah. So, I mean, they're a little bit both related. So, we haven't had any clients that have had to dig into the cost of goods sold well to reach the 40%. But if you did, the definition of covered supplier cost is pretty good, which is a good that is purchased from a supplier that is a good that is essential to your business. So, most of the examples that are out there would say, look, like a restaurant purchasing inventory, that's an essential good to your business. So you can include that. So in your case, I think cost of goods sold, if you need them, are on the table. But in the order of preference, I would go to your second question first and say, look, at the end of the day, unless I misinterpreted the question, you kind of had the best of both worlds between accrual basis reporting and cash basis reporting. So I would have picked up, like real simple example, QuickBooks. It's a pretty small license cost, but you don't have to do it every year. It's only $250. But if I paid that in March, I'm taking the full $250, even though technically I could expense that $250 over 2 years that I'm going to have the QuickBooks license. I mean, that's kind of overkill from an accounting standpoint, but I don't think you have to only use the consumed portion of your prepaid expense during the window that you're talking about. I mean, the only thing they really talked about in terms of, kind of prepaid expenses being a no-no would be a scenario where, you've got a deferred retirement liability for a 401k plan or a SEP or a pension plan, and you try to take the whole chunk of that deferred liability in the window that you're trying to pay it, instead of ratably over the number of periods associated with payroll. But when it comes to expenses, we have not been very hung up on the use of only the amounts in the accrual associated with the prepaid. As long as you weren't in the business of like, let me prepay everything in the kitchen sink, back, and it's just look that this was the normal course, no different than I would have deducted it on my tax return as an expense, even though I hang it up for prepaid expense for book purposes.
Yeah, and there's also a timing issue with that, and I've seen it in a number of places where, with respect to the covered supplier cost, the most concise way of saying is you can't have made up stuff and then said, okay, we're now going to do this, or we're going to do it differently. So meaning that, and I'll just share with you a resource that, covered supplier costs, an expenditure made by an entity to a supplier of goods for the supply that, and there's two components, essential to the operations of the entity at the time the expenditure is made, and is made pursuant to a contract, order, or purchase order that is, one, in effect at any time before the covered period with respect to the applicable covered loan. So depending on which pull you're, first or second, but more important, and also with respect to perishable goods in effect before any time during the covered period. So basically, as I said, you can't make stuff up and say all of a sudden now we have these supplier costs that are up here, or find a favorite cousin that can supply some stuff that maybe you don't really need, or maybe you put an add-on to something. So it has to be something that was, as we call old and cold, already in the process. To kind of take a step back, as we know, the 40% was applying primarily to rent, mortgage, utilities are kind of the main categories. So then they revised it to include covered operation expenditures, property damage costs, supplier costs, and worker protection. So we talked about operating expenses, which is pretty broad, computer stuff, software stuff that you may have maybe not have needed. So there's not this temporal requirement in that bucket with respect to operating expenditures that I've seen with respect to, or similar to, supplier costs, that it could be something that was implemented post beginning pandemic, or within within the period that you had to step up for, like remote work and things like that. what is interesting, the worker protection expenditure is more broad than I think people realize. So it is, air filtration systems. So we represent medical practices that have had to redo a lot of their filtration systems, and some of them are doing like the standalone units in the exam rooms, and some went out and really put the filters where, in the big machinery that you can't see either above or below the space. So things like sneeze guards, expansion of indoor-outdoor space. So maybe you work to deal with your landlord if you're a food provider, a restaurant, and now you've taken part of what was not really a patio but turned it into a patio, but you had to do certain things like put a railing around it because you can't serve alcohol in some places outside unless it is cordoned off, essentially, things like that. Personal protective equipment, those kind of things. We very early on, I think you guys probably saw the mask that we had that had the Shoemaker logo. That was more of a business development marketing thing, but so it's like, okay, well, I don't know if putting a logo on it makes any difference as far as an expense goes, but I mean, we issued all of them to all of our employees in all of our offices, so stuff like that. So, if you're looking for things to spend money on, take a look at some of the subcategories of stuff that you may not have thought was qualified for that expenditure.
So Harvey, thanks for doing a quick follow on. He says, we don't have enough of prepaid license costs to fill the 40% bucket. So being able to use COGS would be huge, and not having to use as much wages and saving for ERC.
Yeah. As long as you're not making up stuff, as Jack pointed out, you're going to be in good shape. Not making up stuff, meaning like all of a sudden started buying a bunch of stuff that you wouldn't have otherwise needed in the normal course. Which I can imagine when you're in like panic mode, you wouldn't have been doing anyway. But
the tangerine Lamborghini, probably not. So don't try to expense that one, Harvey. Other people have tried, and they got the long arm of the law that reached out and grabbed them. All right.
Buy your Lamborghini the old-fashioned way. Sell your company.
Harvey, it's really good to have you on here from Hawaii, man. Thank you for joining us. All right, next question. Wonder if support for the 15% rate will go much beyond the G7. A lot of the other countries with lower rates are not in the G7. Any thoughts on that one?
I think it doesn't really matter from that perspective, because what they're, the whole point would be it'd be a global tax regime. So, even if I was headquartered in like, Nevis, or, well, I guess I don't know if the Dutch are part of the G7 or not, but even if I was incorporated in a foreign jurisdiction like the UAE or something like that has a low tax rate or a zero tax rate, the G7 are basically saying, we don't care. You're paying 15% on your global comprehensive income, even if you're domiciled somewhere else. So all that would end up happening is that the UAE would get their little cut. Microsoft would get a credit back for foreign taxes paid, and then they pay their 15% that then will be parceled out from the G7 based on sales. So I see it I see it not being an impediment to implementation.
All right, next question is from Bob. Yeah, go get some sleep, Harvey. I've never used a 1031 exchange, but my question is, when I use it, do I kick the gain and tax down the road, or do I get to enjoy a stepped up value for the new property?
Now you kick the gain down the road. So just real simple example, and I'll ask Matt to keep me honest on this. Buy a piece of property for $100, depreciate it down to 80, and then I have the opportunity to sell it for 200. So in that scenario, I've got $20 of ordinary income recapture on depreciation and $100 of capital gain. So I buy a property for 300. So my new depreciable basis in the property is my original 80 of tax value, plus the price of the new process, not like the whole 300. So it really is just kicking the can down the road of your original tax liability off that original sale, plus the tax liabilities of all the accumulation of the, hana blah 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 that you generated as you were going. So I mean, the theory would be, hey, if I didn't have to pay the tax today, could I buy more property and have it grow even faster? Yeah, I mean, that's one of those time value money equations.
And I see Matt nodding his head with the BGW CPA Studios background. And so that's good. So before we get to the next question, Matt, go off of mute so people could see your background and you.
This is me.
It's good to have you. And you'll see more of him next week. And we'll go into some more. Before we finish this webinar, I'll have you and Jack elaborate a little bit more on what we're going to cover next week. And then the following week, when you're on vacation too, I think Jack and I are going to go into some additional stuff on how to prepare to maximize the value on your sale of your company. Jack, we can talk a little bit more about that as a teaser before we conclude this one. But the next question is, one other comment. RC Corp loves the 21% rate. We're limiting our bonus in section 179 for 2020 and moving more depreciation into the future in case rates go up. Seems like a good move. Matt or Adam, you want to expand on that strategy? Matt?
I mean, I think it's a great strategy. Short run, we're anticipating the tax law changes. So I think, slowing down on paying some expenses now is a good idea.
All right. You get the 2 thumbs up award, whoever that was that anonymously put that statement in there. All right. So we've hit Harvey's question. He's going back to bed. We've got a couple other questions that have come in. Anything else? Here we go. Do we have any more clarity on ERTC? We have some locations closed for sales business due to COVID, as in New York and Ohio.
Yeah. So with ERTC, there hasn't been any new pronouncements that I'm aware of. I'm going to talk really slowly so Jack can fact check me on that. But he loves it when I do this to him. So you're gonna have to practice this, Matt, how to stall. Very, 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 very long. Anyway, there haven't been any new pronouncements out. So, this would be the scenario where, I don't qualify because I'm not down 50%, but I do qualify based on the exception of government forced a shutdown, which limited my ability to do business, that caused a significant disruption, significant meaning greater than 10%, whatever that 10% is, which could be hours that you could work, revenue reduction of that specific service line, all that stuff. So just, the example, the 2 examples that I feel like there's 3 examples that are on point that in some ways contradict each other, which is why we're advising clients that unless you need the cash, you've got 3 years to go back and file for the credits. They're not going to run out of money. That means you've got until April of 2024 to go back and file the credits. The IRS has 5 years. They increase the statute of limitations, 5 years to audit it. So your worst case scenario is that you paid a consultant who scared you into going back and getting the credit because money's going to run out. It's not going to run out, but you paid a consultant, you get $100,000 worth of credits, pay the consultant, $30,000 for getting you those credits. It was free money to you. You don't care. You paid them 30 grand. You got 70. You're all happy. Everybody thinks everything's, we're all good. Then 5 years later, you get audited and the IRS does not agree with your position. And there are court cases that are against your point that you made. And you got to pay the money back, but you got to pay back 100 grand and you can't get your 30 grand back because guess what? These companies that are applying for the credit right now just sprung up. Like they know what they're doing, but they did not magically exist before all this happened. They sprung up to help people with PPP loans, EIDL loans, and employee retention tax credits. And, presumably when the reason for existence dries up, they're going to go away and vanish. So that's why we're saying, look, unless you really need the cash, you got plenty of time. We want it. No credit will stay unturned. We want to get everybody the money that they deserve, but we've also got time to let things play out. So back to the 3 scenarios that I was talking about. Restaurant, hey, I didn't meet the 50% down criteria while I was shut down in the state of North Carolina, which was, April to presumably, phase 3, where I had restrictions on how many people I could have. So I meet the 10% test, meaning I could only have 50% of my dining space occupied. So check, I qualify for the employee retention tax credit. There is an example that is dead on point with what I'm looking at. Example number 2, medical practice. Yeah, I'm considered an essential service. Government said, you need to stay open, sir. So my first pass would be, oh crap, government said I had to stay open. Well, for emergency procedures only, so I do 2 things. I do, emergency appendectomies, and I also do, not that the same surgeon would do this, but let's pretend that they did, gastric bypass surgery. So appendectomies are up because all these people are freaking stressed out about coronavirus and the global zombie apocalypse that we're in. So that is up. But you know what? Ain't nobody getting gastric bypass surgery. I'm not even scheduling it. So that's down. There's a case that's actually pretty close to this that's spelled out in the literature from the IRS. That qualifies even if they didn't reach the 50% reduction. Assuming the gastric bypass surgery was down greater than 10%. So then you get to the retail establishment where the guidance said, you have to socially distance within the facility. So I would like to point out that some members of the Boatsman family enjoy going to Marshall's. When Marshall's reopened,
I like that new handbag you got, Adam. It's really nice.
If you were unaware, at Marshall's, when they opened, it was like that old commercial, open, 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 open. Like there's a line sitting outside of Marshall's. And once you go into Marshall's, there's a line wrapped around the entirety of Marshall's to get to the checkout stand. It's like a 4-hour process if you want to go to Marshall's because of the social distancing requirement. One would think that would qualify, but the literature says, no, you don't. So, that's why it's like there's things that to me seem to contradict each other in the case law. So where my spidey sense went up is when we had a client that they're going to go ahead and use one of the credit companies to help them out. That's totally fine. They qualify, and I don't think they're going to have a problem because they fit the medical practice definition. But when he said, "Hey, man, they're telling me that CPA firms qualify," I'm like, "What you talking about, Willis?" Well, if you look at their case for CPA firms qualifying, it's because the government issues shelter-in-place order, And people normally would come, and this actually happened. People normally come into BGW to drop off their tax returns, shockingly. A lot of them do. And we have appointments with people, a lot of them. And we couldn't do any of that. So we had to switch to a different process called, mail your crap in or scan it if you weren't already used to doing that, and you're not getting an appointment, which created a revenue slowdown for BGW during that time period. Thus, you were disrupted. I'm like, man, that's a bridge too far. Like, I can't even get there on that one. Because we could still do tax returns. Had people just mailed in their tax returns, we'd, and gotten off the dime and done it instead of, going back to, I just need to hand it to somebody. We'd have been like, I just feel like they're going to come out with some more authoritative guidance on, CPA firms to not qualify. Because that's one where it's like, look, it's hard for even me to make a case on that one. I can see Jack making a case on that one. Anyway, so that's why we're advising people to wait just a little bit. When I say wait just a little bit, quarter three, because you're going to have to amend the tax return to reflect the credit. So from our vantage point, if we think that you got a case, we would like to go ahead and apply for these in the 2021 calendar year to get them in the 2021 tax year while rates are low. But there's no reason to rush and do it tomorrow. Let's at least wait until third or fourth quarter just to see if anything else comes out. Because it's considered, even though the credit is not taxable, you can't deduct the expenses. So it's the opposite of PPP. This credit's going to be taxable income. It will have to be included with your tax return, which means that you basically have up until, the due date of next year, the extended due date, to go ahead and get the tax return done for it to be in the 2021 tax year, which is the position we're taking as a firm, at least as of when I just said it right now.
11:43 a.m. on the 10th of June, 2021.
So let it be written. So let it be done.
I think it's really interesting too, because we're known for being pretty aggressive within the ethical and legal guidelines of the law to try to help you save money on taxes. But when the scenario of where Adam will say, if I had to stand before the judge, and that's really the imperative question. If I had to stand and argue before the judge, could I really do that? First of all, with a straight face and with real conviction. So I think that's an important thing. The other thing that I think is important too is, just like what we've seen recently, we talked about it last week, a large bank, to still remain unnamed, has been kicking back a lot of PPP forgiveness applications, saying, wait a minute, hold on. And there's some interpretation going on. And Robert Mayetta said that he pushed back on that bank and won, but nonetheless, there's some stuff that's going on there. You might as well let some of this stuff get sorted through and get more clarity, versus trying to push it and then have them come back and try to extract that money later on, my opinion. Jack, opinion?
So a couple things I would like to remind everyone on this call, that the opinions of the speakers are not specific legal or accounting advice.
Thank you. That's why you're on here.
I didn't need that amount of time to find out the answer that there's not anything new on, out there. So you didn't have to keep going, Adam, for that entire, dialogue. But what's funny is that, talking about all these companies out there that are like, hey, we can help you. When you do a search that normally would pull up, here's the latest and greatest of whatever the topic is, it's a bunch of commercials for people that are going to help you with your tax credit calculations and everything else. So, and then also the fact that you've created Exhibit A to the IRS inquiry for BGW when you try to attempt to, go through certain things. So that's, it keeps you honest when you're in recording. I just remember, remind you that the little recording light's blinking in our faces. So, but yeah, so there was, again, on the fraud front, kind of switching gears again, I'm just getting more and more the assertiveness and the creativity of these fraudsters with respect to, and since I brought up companies that are willing to help, or you know, hey, provide this information, and they sound, and I've had people who know better that have almost fallen victim to it, and you know, it's and unrelated to anything that we're doing. There apparently the Apple store at South Park, someone has been using their phone number, reaching out to people and saying, hey, we need certain information, and it looks legit on your phone. And of course, if you Google the South Park Apple store, it's going to show up as that phone number. So, you know, just be aware of that. I think that we tend to be very trusting under certain circumstances, and you just gotta always have your guard up, because there's just a lot of bad stuff going out there, and people taking advantage of people that are in situations to be taken advantage of, because you have to trust your accountants, you have to trust your lawyers, and you have to trust you know, government agencies, and you know, be distrustful sometimes of the posers that look like that it's the real thing. So anyway, that's my public service announcement again, in relation to that.
You know, you bring up a really good point. I got a call this week from the U.S. Marshal's office. That's a new scam that's going on. And evidently, my social security number and my identity have been used for fraudulent activity. Well, so I proceeded to hang up and not, you know, hit one to get, you know, progressed to somebody else. And so I did a quick Google, and sure enough, there's been a lot of scams on that. And I called the U.S. Marshal's office and said, hey, I just want you to know I got this, because I saw, and they've been trying to counteract this. And they're like, hey, thank you very much. You didn't give any information. I said, heck no. So, you know, I think especially whether it be this or ERC or anything else where people are, they need to extract critical information, do some due diligence on that company first, you know, and call them directly, you know, as you're doing Google. But especially if you're going to be putting anything out that has critical and sensitive information for you or your company, it's crazy.
And I would add to that too, only because this didn't happen, but there was a possibility. So my teenage son, who got his first real job this summer, asked the following question: Dad, do I have a social security number? I'm like, yes, of course you do. You haven't had to use it. But here it is, forever and ever. Store it in a place that doesn't actually say social security number on it, like whether it's in your phone or wherever. And just be mindful that that is the gateway to everything about you, just because that's the way we've developed as society. That's our identity, and that is used for a lot of, it still amazes me that you know, how many digits is it? It's 3, 5, it's 9 digits, right? So a 9-digit number, a serial number issued to us, is such a gateway to so many things. Yes, you have to show multiple forms of identification, but I mean, if you don't have your social security number, you can't get a driver's permit, as I found out when I stood in line at DMV with that particular child, and they said, thanks, but come back when you actually have that little card that was issued to your child many years ago. So just again, if you have children at home, even young adults that maybe haven't had to experience those kind of things because you know, they're in college or whatever it may be, I think we don't really appreciate the creativity of trying to get stuff out of people who just haven't been, their skin hasn't been hardened just through experience of being taken advantage of, or having friends or others being taken advantage of. So again, sorry, not to get on my public service announcement soapbox, but I see this happening over and over again to some really good people, and it's shameful.
Well, at least you had 2 hours of quality time at the DMV while you're waiting to find out that they couldn't service you because you didn't have a social security proof there.
Yes. Yep.
Oh my goodness. Any other questions out there? This has been a good one. While we're waiting for that, Jack and Matt, you guys want to talk at all about what we're going to be covering next week, besides any PPP or ERTC questions that people may still have?
Yeah, I'll jump in. I appreciate everybody being on the webinar and looking forward to jumping in next week and filling the big shoes of Adam Boatsman. One thing I do want to echo just on, identity theft and security. One things that we work with our clients and we've noticed is just be careful what you email and what you click on. It's not safe just to attach a W-2 or a tax return to an email, because that's sitting out on the interwebs for anybody to grab and take a look at. So just make sure you're sending sensitive data encrypted. Just a quick about me a little bit is I owned my own CPA firm for 8 years prior to joining BGW, came on board at the beginning of this year. What I've learned is, I think, different than other CPAs is the empathy for the entrepreneur. As owning your own firm and being the own guy out there, it is tough to manage everything that you have to do, and it can be awfully lonely. And what I will say is, joining BGW, to be able to participate in a forum like this where we can share knowledge, ask questions, and get questions answered is huge. So as we look into next week, I know Adam is really big into just everything that's going on, legislative, forward-looking tax strategy. What I like to bring to the table is client issues that I'm seeing. Jack and I had a great phone call last week with a mutual client, and this is an existing business owner, serial entrepreneur that had questions on basic entity structure. So I'd like to share some, information from sole proprietorships to C corporations, the pros, the cons, the benefits, and then some just things that you need to be doing on a regular basis to make sure your T's are crossed and I's are dotted. So I look forward to any questions. Again, these are some big shoes to fill, Adam, and I don't know if I'm going to be as long-winded or be able to stall out as long as you can, but we'll do my best.
Well, there's only one Adam Boatsman, and that's a good thing, and it's also a sad thing but a year ago, little over a year ago, we've been pushing hard on Matt because we needed an Adam Boatsman 2.0. And, fortunately, the timing was right, and we got to get him and his team, which really fit us because they only work with privately held business owners as well. And he was trying to emulate what we're trying to build at BGW. And so he is an Adam 2.0, and we're really glad to have him. And, different strokes for different folks. We all have different personalities, but you're wicked smart, and you're a good guy too. So any other questions out there? Jack, any thoughts before we go, while we're waiting for questions, or before we sign off?
So just to a little more with the thing that we're doing next week with Matt, is just similar thoughts that, things that come up, and it's, just operational things, opportunities and things like that you're like, okay, well, you're going to do the same as before just because it's of habit. You're going to form an entity, you're going to do this, you're going to do that, but maybe just some things to consider. I would call it, maybe like the business of law, or the law of business 201 or something like that, if I were, trying to put a name to it. So and just talking about a few things. And so bring your kind of general questions to the show next week. As far as so I'm gonna, because I'm at the office and I don't have my father joke calendar. I had some really good ones that I was saving up, and I just left them at home, so I'm sorry. We'll have to maybe double up next week. But instead, Adam a little while ago used a phrase from so if you can name that movie, or that actually is a show that from the 80s, it must have been from the 80s because that's when I remember it from, but you have 10 seconds essentially to name the show that he used, and he used a character's name in what he said. So if you can't get it in 10 seconds, then you don't know what it is. I'm counting.
And
Anyone taking
the
it?
hint was it's not about Bruce Willis.
Oh, you're making it too easy.
It's not a Die Hard movie. Nobody.
All right, nobody. All right, so it's different strokes. I can't remember the question from last week. I realized after we got off the phone, I didn't tell the answer what it was. But so anyway.
I don't remember either.
Yeah, I have to rewind the tape or something. So Matt, that's what we do. In order to make people pay attention, we, throw stuff out at the end to see if they're actually paying attention. So.
And unwittingly, I even said different strokes for different folks, and that was not intentional. It was a subliminal thing. You were doing your legal wizardry and all that, messing with my head, I guess. I don't know. Adam, we're going to miss you for the next couple weeks, but we sure hope you and your family have a ton of fun together.
Yeah, absolutely. You guys are in great hands, and enjoy tuning in to see the replays.
All right. All right. Well, we're going to go ahead and sign off. For anybody that was late on this thing and you missed the front end and Harvey's question or whatever, we will put this up on the BGW CPA YouTube channel later on this afternoon. Thank you for tuning in. We appreciate each and every one of you. See you.
Bye.